Well, let's do chapter 17. I'm looking in the book on page 1012, and I just want to kind of mention there's some good information there that will help you quite a bit. The chapter starts out kind of walking you through the basics of the cash flow. Now, it's kind of a continuation of chapter 4, and that was way early in the semester when we looked at chapter 4, but that was a cash flow chapter also. And this is kind of a continuation of that chapter a little bit. And they kind of walk you through the purpose of it, some reminders. There's the direct and indirect methods. We're going to focus on the indirect method. And if you can recall, that really dealt with the one of the sections called the operating section. So there's operating, investing, and financing. And the operating section can be done with either the direct or indirect methods. The book talks about both. We're going to focus on the indirect method, and you always know you have the indirect method when you see net income as the first line of the operating section of your cash flow statement. So just kind of keep that in mind. So operating, investing, financing are the three categories that we're going to look at. So that's what the chapter kind of starts you out with some of that information. And then page 1010 starts the indirect method. And then I've already mentioned page 1012, but I should just really think through page 1010, 1011, and 1012 are really kind of the heart of the indirect method. And a lot of your homework will be based on understanding the indirect method and then doing kind of a short cash flow statement also. So that will help you quite a bit, and they'll kind of walk you through the preparation of the cash flow statement on page 1014. So those are some kind of important chapters for your homework. Okay, so why cash flows are important. Remember that the income statement is based on accruals, revenues earned to expenses incurred, and making sure that we've got a good net income measurement. And that's fine, that's very important. We need to do that. But that does not take into account cash received and cash paid. So we can earn a revenue in one period and receive the cash for that revenue in another period. We could incur an expense in one period and pay for it in another period, and so on. So I think everybody's aware of that. Think way back to accounting principles and some of the adjusting entries that you do. So we want to be aware of that. And also, because this is a financial statement analysis class, we want to focus on what are some of the issues that management can do to manipulate income by postponing discretionary expenditures, and so on. So we've talked about a few of those things throughout the class. We can talk about write-offs, things like that too. So you also want to kind of have in the back of our minds, what are some of the issues that management can do to intentionally make the numbers look not quite as bad as maybe they really are, or whatever that can be. So the cash flow statement is a way to kind of catch some of those issues. That's kind of why we want to do this. So overview of the cash flow statement. Again, remember I kind of mentioned these: operating, investing, and financing. And I just want to remind you too, kind of with each section, where the vast majority of the data comes from to complete that specific section. So for the first one, net cash from operations, that deals with your income statement and the changes in current assets and current liabilities. Basically, what's the cash generated or used by whatever business it is doing what it does. So if it's Best Buy, for example, we all know what Best Buy does. So the process of buying electronics from suppliers and selling them to consumers should generate positive cash. It may not every single quarter, but generally it should. So that's what they do. That's their operations. Then from investing, think about long-term property, plant, and equipment, or long-term marketable securities. Okay, so this is taking extra cash, investing it in stocks and bonds. This is the purchase and sale of property, plant, and equipment. And then the last one, net cash flows from investing activities, that deals with the equity section of the balance sheet. Basically, where do I get my financing? If we borrow money, that'd be cash flow in. If we pay off the principal of borrowed money, that's cash flow out. If we pay dividends, that's cash flow out. If we sell stock, that's cash flow in. If we buy treasury stock, that's cash flow out, and so on. So anything that affects the equity section. So just to recap that, because it is important, the cash flows from operations deal with your income statement, current asset and current liability. Investing deals with long-term assets, and then cash flow from financing deals with equity and also long-term, I should mention long-term liabilities also would go in there. Okay, so that would be your net increase or decrease in cash when you add up those three together. So I mentioned the direct versus indirect method. We're going to focus on the indirect method, and we know it's indirect when we start out with the income, net income on the cash flow from operations. So here, and then of course is an income statement. We all know what that looks like. You can see the net income number at the bottom for two different years here, 15 and 14. And then we take the cash flow from operations. Now this is using the direct method, so it does not start out with net income. That's how you would know it's the direct method. So we're going to focus on the indirect method. Again, we take the accrual basis net income, and we make adjustments to that for things that are not cash. Okay. So great examples of non-cash expenses, of course, are depreciation and amortization. Also, we make adjustments for non-cash revenues and gains. And then we do want to record items excluded from the accrual basis net income that did affect operating cash flow. Cash inflows received but not recognized as earned, and cash outflows as paid but not recognized for accrual periods. Okay, so here then is a cash flow from operations based on the indirect method, again starting out with the net income amounts and then making various adjustments to get down to a net cash provided by operating activities. So if you prepared a cash basis income statement, that would essentially kind of be the bottom line. It's kind of a loose correlation to that. So they're going to walk us through all the various adjustments that we need to make. And one of the very first ones, of course, is the depreciation / amortization. It's a non-cash expense. So net income up here has been lowered by this amount of depreciation, so we need to add it back. So it's a positive here because that, without that, net income would have been higher. Again, we make adjustments then for how things have changed. In this example, we've got deferred taxes changed. It was a deferred tax liability and then a deferred tax asset. The difference between the two was $307,643. When this happens, the debited income tax expense exceeds what was paid, and we have to add that back. So it's an increase in liabilities must be added back. And that's kind of the way to kind of think this through. There's kind of a general rule of thumb when it comes to doing these. With liabilities, if a liability increases, you add it to this adjustment. If a liability decreases, you subtract it from this adjustment. And then assets are opposite. That's how I remember these. Just think assets are opposite. So if an asset increases, it'd be a decrease here. If assets decrease, there'd be an increase here. So liability is the same, assets opposite, and you're good to go. So these are all your various changes in current assets and current liabilities. Stock-based compensation. Remember that with stock-based compensation, it is stock given to an employee. There's no cash involved, but it is expensed as it's incurred. So you would debit expense when you do this award, but you're not paying cash, so we're going to add that one back. And the gain on property, plant, and equipment type transactions. So let's go back to this being Best Buy as an example. Best Buy in the course of business may buy and sell land, buy and sell buildings, buy and sell equipment. We all know that's not what they're in business to do. They may do that just, every so often. They're really in business to sell electronics and services related to electronics to us as consumers. But it's just going to happen that you're going to exchange or sell off some property, plant, and equipment, have gains or losses. And you want to back that out of cash flow from operations. So that's why we're doing it. There was a gain, and we subtract the gain. We don't want it to show up in this section. Instead, we want it to show up in the investing section. Okay, so we're just taking out of this section because we don't want this section to show cash provided by doing what that business does. Okay, buying and selling electronics to consumers. And then we make our various adjustments for the various current assets and current liabilities. Just kind of walking us through this. Okay, so just kind of walk us through all the various current assets, and then they're going to kind of do the same thing here with the these are all assets at this point in time, I guess. Yeah. Okay, and then so just kind of just walk us through that. Those are really easy to follow, and that's kind of why I wanted you to look at pages 10, 11, 12, and 13. That's really kind of where they walk you through paragraph by paragraph what the various adjustments are for that. Then preparing the cash flow statement, we talked about the T account approach a little bit way back in chapter 4. We talked about a spreadsheet method way back in chapter 4. We're going to do a little bit of that again today with the homework. You might recall I had you, we looked at one of these. We did one together in the classroom way back when we did chapter 4. And I used to do these. This is something that I did frequently when I was doing this kind of stuff in industry. You're looking at reconciling the changes in a balance sheet from one year to the next. And every change relates to cash flow. And that's really what this spreadsheet is doing here. So just kind of be aware of it. We're going to do kind of a mini one. And they're kind of doing here a very indirect method put together cash flow statement for us right here. So remember, we start out with net income and we make our various adjustments. So we have our cash flows from operations, investing, and financing after that. And then we're going to kind of focus a little bit in this chapter on some of the more challenging items. So in chapter 4, cash flow was kind of the more straightforward type items. This chapter is going to throw a few of the more oddball items at us here. So we're going to focus on some of the more unusual items when it comes to cash flows. We'll look at some straightforward ones too, and then a few other ones too. So this kind of walk us through inventory. What happens when inventory is written down, for example. Inventory gets old, it's obsolete, we're just going to write it off, maybe just dispose of it, whatever we're going to do. When that happens, of course, that requires an analysis of the account. And that's really what you have to do a cash flow statement well, is really get down to the nuts and bolts of looking at your inventory account on your general ledger and looking at all the various transactions that went through the account and finding anything that just seems unusual. Sometimes you have to drill down to that kind of detail. And you're looking for things like write-offs and whatnot. And you want to make sure you handle those the right way. Same thing with property, plant, and equipment. You have to kind of analyze the account. And again, you're looking for, was anything written off here? What did we sell? What did we acquire? And kind of being aware of anything that might be unusual, especially if we sold something at a gain or a loss. We have to be aware of what that gain or loss is to adjust cash flow from operations accordingly. Remember that the investing section deals with property, plant, and equipment and investments like marketable securities like stocks and bonds. So this is showing us a 3-year look of the investing section for a specific company here. This is for Amazon, their investing section. And this is typically negative also, so don't be shocked, especially with a company that's growing like an Amazon. These are typically negative. Now, of course, you want your cash flow from operating to be positive, because that positive cash flow will then help pay for or contribute to paying for investing in my business and buying property, plant, equipment type assets and taking any extra cash that I have and investing those. So you can see here for Amazon in the most current year, they invested more than what they or they sold off more than what they sold. You know, some years it works out that way, some years it doesn't. So you can see here that they sold off 4.2 billion in 2012, but invested 3.3 billion, for example. And this is the financing section for Amazon. Again, remember, this deals with equity and long-term debt. So bonds would go into this category also. So if a company pays a dividend, it'd be a cash flow out. If they sell stock, it'd be a cash flow in. If you borrow money, that's cash flow in. You make principal payments, that's cash flow out, and so on. Amazon does not pay dividends, so you wouldn't see that one here. But most companies own some stock. They'll buy at least some stock and keep it on hand so that they can use that to award stock-based compensation. So you might see some payments like that. And then sometimes keep in mind that you can have an item that does not affect cash, but it does affect either financing or investing. An example here would be buying a building, but then just using debt to pay for it, right? So I debit building, I credit mortgage payable for the exact same amount. Acquiring an asset by entering into a capital lease, issuing stock or for non-cash assets in connection with a business acquisition. So just keep in mind the cash flow statement will not pick these up because cash was not affected. And so you have to disclose a non-cash statement exhibit here for anything like that. So supplemental cash flow information. So if any acquisitions of property or anything like this was done where cash was not involved, then we have to go about this process of doing it this way. So then some ways that, and this is where I think this class is unique from other classes, is we want to be very aware of what can management do to manipulate or distort its financial statements. We want to be kind of aware of what those methods are. And here's this slide kind of lays this out for us pretty well. Operating cash flows can be distorted or legitimately managed, and we have to be on the lookout for that. Changes in working capital, right? So remember that a lot of what goes through operations is current asset and current liability. Well, working capital is current asset and current liability. So this accelerates the collection of receivables in the current period or delay the payment of accrued expenses when accounts payable until after the period ends. So if I do either one of these, I'm going to increase my cash flow from operations, right? So maybe what I do is, I want to increase my cash flow from ops. So I'm getting towards the end of my fiscal period. I can maybe begin to give some incentives if people pay me early, or I can just work the phone and see if I can get people to, pay me early, remind them. I can then slow down my payments for my bills and pay them in the next accounting period. My cash flow from operations will magically increase. So, I can work some of those things. Also, it says here with account receivable versus collateralized borrowing, it says classifying receivables sales as operating cash flows may provide a potentially misleading picture of sustainable cash flows of current operations, because what can happen is what some companies will do is they will sell their receivables. Okay, and if you sell your receivable, then that creates some distortion. And then capitalizing versus expensing. If an asset is capitalized, we then depreciate it versus something being expensed immediately. So if it's capitalized and later expensed, depreciation and amortization are non-cash items that don't reduce cash flow from operations. So if a company can begin to find some ways to creatively capitalize some certain things versus just expensing them straight out, it may also then increase cash flow from operations. So just some little things to be thinking through and be aware of when it comes to the cash flow statement. And then just some other examples too. Remember, we've talked previously about software development costs and what they call technological feasibility. Remember that most R&D things are expensed as incurred, most research and development. Software, though, is one of those exceptions. And it says here that software companies must expense all software development costs as incurred until we reach technological feasibility. Now, what the firm can do is select a low threshold for what that means. And if they do that, of course, what happens is we are then going to be able to capitalize more of these costs and then amortize them down the road and increase cash flows in the short run. And then capital versus operating leases. We talked a little bit about leases in this class, and they get talked about in other classes too. But remember that an operating lease is just simply a lease payment is classified as an operating cash flow. An operating lease would be like if you are currently renting a house, renting an apartment, something like that. You have no ownership, right? When the lease ends, you either renew or you move out. That's an operating lease. A capital lease, though, is also can be called a financing lease, and it's really a vehicle to help you finance a long-term asset. So, you could enter, a business does this frequently, enters into either a capital/finance lease, where the lease payments are really a way to finance the acquisition of a long-term asset. And so with that in mind, those types of payments are classified more down in the investing or financing categories of the cash flow statement. They don't go through operations. So, we can, by deciding what kind of leases we get into, that can then kind of manipulate what our cash flows are. And remember that cash flow from operations is kind of the first place a lot of investors will look at, financial analysts will look at. They want to make sure the company does generate positive cash flow. So if a company is entering into capital leases on purpose so that its cash flow from operations will go up, well then that's kind of manipulating that number a little bit. Okay. And then cash flow effective stock option expensing. Again, that's another one too that we mentioned earlier. When you grant stock options, cash is not impacted. It is an expense though. There is an expense there, but it does not impact cash. So that's another way to basically pay your employees and not affect cash, and make sure your cash flow from operations goes up a little bit. Okay, I'm going to skip the global stuff, but that gives you a good flavor for the chapter. So I think a lot of it should be somewhat familiar based on it's a continuation of chapter 4, and we're going to focus a little bit more on kind of just the oddball stuff and more of the ways that you can manipulate your cash flow from operations from management's perspective. It's a little bit shorter chapter, I think, too. So hopefully you won't find it too terribly difficult to do. As always, if you've got questions, just let me know. Thanks.